Okay, it's on. Cool. So today we're going to go over two pretty straightforward strategies for Forex. Um, First and foremost, there's going to be different time windows. We're going to be looking for these two. It's going to be one base in the London session and one base in the New York session. So if you're trading these setups, you need to trade pairs that correlate with that session. So, don't be trying to trade Aussie JPY and it might work, but if you're looking for the way that I'm using these, or the way that I would use these, um, I wouldn't be using pairs that aren't really tightly correlated with whatever session you're looking for. So, for example, the first model we'll go over is going to be the one in the London session, and you would want to be focusing on any forex pairs that contain euro or the pound, right? We could use, literally anything that has that in the pair at all, right? So that's a lot of pairs. You don't really need much more than that. I mean, that's going to give you pretty much most of the pairs that most people trade, anyways. I think have one of these in them. But another thing that I want to be very clear on is that you have to be super, super confident on your daily bias, or just overall understand where you are relative to the range. So, if we're looking at trades in, let's say, this price leg right here, like we have a impulse to the upside, right? Well, as soon as price comes into any of these bullish PD arrays, we're gonna be looking at a potential bullish scenario. So you'd want to look at things in that kind of context. So we'll actually go back and just see if there was any setups around this day during the time that we're talking about, because oftentimes there is. Yes, there actually was one. So, the first thing you want to do is identify what pairs you're trading. So for this setup, you could trade euro dollar, or again, anything with the pound or euro in it. And you're going to be wanting to look for the entry to occur after 1 a.m. Eastern and before 4 a.m. So whenever we are looking at price, of course, we have to look at it from the correct lens, aka what's our bias? Are we looking to be bullish, or are we looking to be bearish? Right. So after we've checked our higher time frames, and notice I didn't go into some crazy thing where I go back and look at all this structure, and I'm not doing that. I'm just saying, okay, what is price doing? Is it displacing to the upside? Are we obviously drawing toward? Do we have some clear area we're drawing towards on a higher time frame, maybe like the weekly, right? So at these times, you don't want to overcomplicate bias. You just want to ask, what is the direction of the recent impulse? Are we retracing that impulse, or are we likely to expand, right? So once you've established that, you want to take a look at the dollar. So on this day, what is this? 11/21/22. We're in the 1 hour. Or no, we're not. Never mind. So on this day, if we're looking at this is the 22nd. That was where we are at. Or was it 11/21? It was one of these days. So at this time, you're looking at the dollar and you're saying, okay, well, the dollar is impulsing to the downside, and now we're pushing back to the upside, right? So at that point, you're going to see that kind of reaction. So as the dollar is reaching areas where you're likely to be bearish on the dollar, and the euro is likely to you're reaching areas where the euro is likely to be bullish, you can use that in kind of confluence to determine and accentuate your bias, right? You want to make sure that you are paying attention to DXY. Another thing you can look for is breaks in correlation, aka SMT divergence. SMT divergence is not really required, but it is an added confluence. So, again, always after you check your daily bias on whatever pair you're trading, you want to make sure to look at the dollar. Whether it's looking for SMT is not really required, but you want to make sure you're looking at it and understanding, okay, this is lining up with my analysis on my chart. Because with Forex, especially pairs with the dollar, you need to make sure that you're paying close attention to the dollar, because it can easily save you from taking a bad trade if you allow it to. So, once we have established, okay, well, the euro is somewhere it's likely to be bullish, and the dollar is somewhere it's likely to be bearish, well, then we're going to start looking for our overall trade setup. So, we can also go back to that daily and note any key levels, right? So what would be key levels in the daily? Well, we're in this fair value gap. So you could mark out this just to keep that visual. We also have buy side liquidity up above where the market's likely to retrace to, right? So we're looking at the market in a sense of, okay, we've got a clear area where the market's likely to draw towards, and we are, oh, these are all others. I forgot we're on replay. I was like, what is this? But we have an area where the market's likely to draw towards. We have bullish price delivery raise. We have a bearish dollar. And at this point, we're pretty confident that the market is going to go bullish for this day, right? We know that the odds are in our favor. And of course, we don't know anything for sure. But if we're looking at the market and you had to say, are we bullish or bearish? You're going to say clearly bullish, right? So the next thing you want to do is look for the Asian session and watch any obvious areas of liquidity in the opposite direction of our bias. So if you're bullish, you're going to be looking for lows, and bearish, you're going to be looking for highs. So in this example, I'll go down to a 1 hour. And remember, we're going to be looking for this setup to occur here. Actually, it looks like there's two setups. So we'll be able to show a counter trend setup and a pro trend setup. So we'll focus on this one first because it's a little clearer. So vice versa, like when we were in this area up here, and the market hadn't retraced down to our area, like that was been on this candle, you could have been bearish on this same bullish impulse. This is actually a really good example. So I get a lot of questions of people that are, they just get stuck on one side of the market, which it's not necessarily bad to do that because you only trade pro trend, but sometimes there's a lot of opportunities that are missed because you're not able to use the bullish trend to get in a short, right? And that sounds kind of counterintuitive. But if we're looking at a bullish trend or we're looking at a bullish displacement, we're going to have to retrace to go bullish, right? You're not just going to buy forever. If you're bullish and you just keep buying, obviously you're going to get stopped out. So let's go back down to that Friday, which was back over here, and during the London session. So we'll just draw a box on the London session, or we'll just draw it from midnight on. We'll just, how about this? This will be easier. So when we look at the overall previous session at this point, let's go to like 5 minutes to make it a little clearer. And we'll mark out the Asian range. So from 8 p.m., which is 20, or most of you guys know that. I don't want to be explaining that, but you're going to be able to look for a range to form in this area between that 8 to 12 p.m. Super simple. Yes, I know some of you guys are wondering about the CBDR. You can use the CBDR. We have old videos, and that I'm not going to go too much in depth on it. The only way that I would really use this is for standard deviations if it's tighter than the Asian range. So that would begin over here at 2 p.m. And then just you can watch for it to form all the way to the Asian range, right? I've messed around at different times of this from like 4 p.m. But 2 p.m. usually is where I start to see the consolidation on major Forex pairs. So for anyone that's wondering what I'm even talking about, it's just a range where you can draw a fib on the high and the low if it's consolidating nicely, right? You can even draw it here if you want to be a little bit more liberal, but really this is the consolidation I see. So at this point, we're going to look for the high or the low of the day to form at 2 standard deviations on most days of this range. You can see that the high of the day formed at 2 standard deviations. Now, if it's a red folder news day, you can look for much, much higher targeting. And obviously, those are just lower probability circumstances. But anyways, going back, again, just to kind of retrace. Remember, we're bearish at this point on the day because we're in a bullish impulse, but we're looking at this fair value gap as the next kind of area as possible support. Like this is where the market is likely to give any kind of setup in a bullish sense. So if we understand that, we're going to be looking to take the market down to that. So this isn't necessary. This is kind of like the SMT divergence. You can just look at this as an added confluence. Hey, if you're looking for a sell and the market just traded at 2 standard deviations, then you have higher probability circumstances than if it didn't. So what we're going to want to do is we're going to want to map out the Asian range liquidity, right? So this is where bias comes into play and is very important. So there's oftentimes going to be two setups, right? So here's the low. We'll just mark the low right here. Mark the high. So there, sometimes this won't happen, but if let's say if you're very bearish and you do see the lows ran out first like this, right? So again, if we're bearish, we want to see a rush to the upside first, right? Accumulation, manipulation, distribution. We want to catch the manipulation. We want to get in where other people are looking to get on the wrong side of the market. That would be up in this area, right? Now, you may be wondering, well, what happens if the Asian low gets ran first like this, and then we displace up? Because what happens is a lot of people is when this happens, they switch their bias. They say, oh, I must have been wrong, and they're really eager to get into a trade, and they at this point they say, okay, this is the low of the day, I'm getting in along, I'm targeting out buy side, when most of the times they're just going to get stopped out because they switch their bias just based off of one simple little leg in price action. So how do we avoid that, and how are we able to capitalize off of this kind of stuff? Well, it comes from trusting your bias and managing your trades as such. So for example, if I am bearish here based on a daily time frame, now we're on a 5-minute. So why would you switch your bias based on a 5-minute compared to something that's built on a daily or a 1-hour time frame? First and foremost, right? And this is where people lack awareness and they just get in these stupid situations where they end up really frustrated and they look back on it and it was obviously stupid, but nothing you can do at that point because you've already made that decision and now you have to bear the consequences. But if we're looking at the market in a bearish or from a bearish perspective, we can still take longs, but we're going to be they're going to be short lived. They're going to be scalp opportunities. So what I would like to do in this scenario is if the market shifts up with displacement after taking that Asian low, right, which is over here. Does it shift with displacement? Yes. I would consider this a displacement for sure, right? So in that displacement, you're going to be looking for a fair value gap or a break or whatever you want to look for, right? You could look for the order block. You could look for a fair value gap. Most of the times I would look for a fair value gap in this scenario. And you can look to trade from that, but you don't want to take this trade for a super, long distance, because this is where a lot of people start using concepts that work otherwise very well, but they use them in the wrong context. So they'll say, okay, this is standard deviation of this. Okay, 2.5. Oh, it lines up perfectly with the buy side. I'm going to long to the buy side, and then it doesn't work, and then they don't understand why. But it's just because they have the wrong bias. So instead of trying to swing for the fences when you're trading, overall against your plan in a way, how do you trade with your plan? How do you trade with your plan but against it at the same time? And the answer is just taking profits a lot sooner. And sometimes not even taking the trade because you're looking at it as a short-lived trade. And if it doesn't have good risk to reward, you're kind of just fiending for a trade, right, so to speak. But as soon as that displacement happens, you can look for some kind of entry and then look for the Asian high. Now, I will say this is lower probability than the trade that the actual model we're going to be discussing, but it does happen quite a bit. So maybe you can add this into your strategy and only take it with half risk. That's usually what I would do with a strategy or with some kind of entry like this, instead of just taking full risk. Maybe have tighter stops. Different things you can do to kind of navigate that. The way I would do it is just the most recent swing low and just target out that Asian high. Now, this is a pretty good opportunity, right? Not every time it's going to go straight to TP like that. I wouldn't go down to the 1 minute at all in this whole strategy. We're just going to be using the 5 minute because you really don't need the 1 minute. And I think a lot of people that trade indices a lot, or a lot of people that came in from the 2022 mentorship, think that you only can trade the 1 minute. And that's just not true. And especially for newer traders, I think it's actually really bad because the 1 minute gives you, quote, a bunch of opportunities, right? Not all those opportunities are good. And what happens to a lot of people that I work with directly, they know what they're doing, but they have so many stupid mistakes along the way to their good trade that they just end up break even or a small loss or small gains. And then after so long, that kind of trading bears down on your mental equity and you start fucking up, and that's how it happens, right? So anyways, that was a little bit on 5 minute, 1 minute charts, but most of this is going to be, or all of this is going to be on the 5 minute chart. So after we see this happen, though, this is where we're actually looking to trade, right? This right here is what we're looking at as the likely manipulation, right? We want to see that high to form. Now, what is an added benefit? Well, if it's at 2 standard deviations or more than the CBDR, but again, this isn't required. This is just like an added plus, right? And then we want to start to look for some kind of sweep and shift to the downside. So at this point, do we have a sweep? Yeah, we swept right here, right from that high, and we swept the Asia high, obviously. But do we have much of a shift in structure? No, we don't. Right? Why? Because the next structure is all the way down here. So are we going to wait for this structure to form? I'm sorry, to be taken. Not necessarily. In this example, you would have actually had an opportunity before it got taken, which was right here. Because we're looking at the market from the sense of what is it doing right now. We're not looking at it from the sense of, you know, this high or this low made this high, and we're only looking for that because we're trying to navigate things a little bit more nimble. And we want to watch for displacement to tell us that the market is doing what we want it to do. That's really our signal, right? As displacement. That's the market telling us you're right, so to speak. I mean, hopefully right. We never know for sure. But that's our way of, you know, because confirming with market structure is cool, but confirming with displacement is a lot more reliable. Because again, what are we trying to confirm? That the market's going to reverse here. What does the market do when it really starts reversing? It displaces, right? So at that time, whenever you do get that displacement, you can look to either enter on the displacement if you have good risk to reward, because our targets are going to be far away. So let's go back out of the 1 hour. I'm getting a little ahead of ourselves. So first off, this right here is your entry signal, so to speak, right? This is what tells you it is time to either look for an entry or enter the market. So let's just say in the first scenario, you enter the market on that candle closure, because that's a displacement, right? Your stop, you want to always have up above this high up here, right? So a very good way to, there's a couple ways you can do targeting here. And this is where it's going to be a little bit more up to you. I will say the most conservative and probably consistent way is just flat 2R. And the reason I say this is because this strategy happens a lot, and it is very, very probable that you're going to get 2R, right? There's going to be some days where it gets this and then ends up consolidating. There's also going to be some days where you could have got a lot more. So first way you could target is just 2R, right? So let's go back, and another thing that I want to talk on before I move any farther, because I know some people might be confused. The way that this has to happen before you're even looking for this kind of setup, right? So you could look at this as one setup as well. This happened more close to the London session, like the time windows we're talking about. But ideally, you would want to see something like this happening a little earlier. This example, it happened a little later than 4 a.m. But this is what you're looking for. If you're bearish, you're going to want to see that Asian high ran out. So let's go back out to like a 1 hour. What you can do other than 2R is just look for the next 1 hour liquidity. All right, so the next 1 hour liquidity would be right here. Or, you know, if you want to be a little bit more liberal, you could say right there. Because, yeah, I mean, we moved rapidly off here. There's a swing low. We all know that most of the liquidity is going to be lying under that. That is another way you can do that. So that's the targeting method number 2. That would have gotten you a little bit better risk to reward. Now, another way you can do this is target your daily level, right, which was that fair value gap. This would have been something you held over the weekend, so you probably wouldn't have held it, right? So I don't want to be deceptive and say this was like, oh, you can get 4R, because, I mean, I don't like holding Forex trades over the weekend because you can get gapped. You know, stuff like happens this weekend. Like I'm expecting potential gaps from all this Russia shit at open, so we'll see. But anyways, if you do this method, I think you should definitely trim at the first 1 hour liquidity, at least 50%, if not more. But again, I think the best method for this is just the fixed 2R, man. I think it's solid. I mean, because here's the thing: this setup happens multiple times a week, on each pair, so you don't necessarily need more than 2R to make good money because it's a very high probability setup, right? If you actually are patient for this, you wait for that shift after the liquidity has been taken, you're gonna have a very solid trade entry most of the time. So let's look at the pound. I'm just going to go on that chart and just try to find some kind of random area. The New York session, the New York model is actually what we used to trade the pound last week. So I'll leave that up and we'll go into that. I'm going to go to a different pound chart. Oh shit, it's been a while since I've been on this one. So we'll go back down to, let's go to an area where random spot on the chart. So at this time, we're looking at the market in a bullish sense after it trades into this and moves away. And the way you can kind of confirm that, again, just this more biased stuff, is look for a shift in structure on like a 1 hour. We'll just do this to mark the range. See, at this point, you know, on the daily, you can look at this and it looks like it's pretty bullish, right? It's most likely going to remain bullish. Are we trading this order block right here? I haven't really seen much of a displacement to the upside yet, in my opinion. Like the only even closure is right there, and then we immediately push down. Let's let this play out just a little bit more. And it looks like, so that now you got more of a displacement to the upside. So at this time, let's look at, let it play. Let me mark out the next Asia session. I'm trying to find just random examples because, oh wait, it's already here. I'm trying to find just random examples to go through with you guys because I think it's better to do that than to pick like cherry picked ones. So in this example, hold on. We already kind of went past what I was looking for. We'll just use this other displacement. In this example, at some point you're looking for some kind of retracement here. You haven't really gotten a signal that you're going to get it. Let's see if we get some kind of shift down. So at this time, you've got what looks like to be a pretty clear draw on liquidity, these lows right here. You also got to be mindful you did take this out and you are trading inside of this fair value gap and then this order block down here. But let's go to the times. So we mark out the next London session. Mark out midnight. So this time you'd want to go back into that 5 minute and we'll mark out, I need to mark out Asia as well. Okay, so similar setup in terms of we have a pretty nice consolidation here with Asia. Asia high was formed just before that midnight. So this is actually a tricky one. I could see how it would be because it takes out the low and then goes straight to the high. But again, this is where bias comes into play. So this time we'll go back to that daily. Market really hasn't traded into any kind of higher probability setup on this day. Yes, the market traded up, traded back down into this order block over here, and then started to displace above. But it's kind of consolidated here and been pretty choppy. But again, you want to be mindful that we do have this low right here, but the market had traded into a 1 hour order block and taken out this liquidity right here. So at that point, what I always like to do, if I'm like confused on bias, is just go back and watch how the market was reacting at these levels, right? Because if I look at this, I'm like, okay, well, I could see the market could easily retrace, you know, from any of these areas back down into that discount. So if the market is displacing up on a lower time frame under this level, you want to be very mindful of what you're kind of moving into. You've got this little buy to sell range right here that caused a pretty big push down. I'll just make that light. But we can go back and watch on the 5 minute how he reacted under this low right here. So at that time, you see that the market, and this is why I preach displacement all the time, because you can really tell what the market is doing or what its the course it's on by even looking back sometimes. So if I look and say, okay, well, the recent liquidity was taken was on the sell side, and we displaced to the upside, and we've been running out stops and then displacing ever since, right? So every time you see this kind of price action, take out a stop, and then is this a high? Yeah, it's a high right there. I was like, I knew I saw one. And then displacing up, right? Market's just consistently just pushing up, taking out stops, and displacing up. So at that point, you're looking at the market in a bullish context. You'd have a bullish bias. And this is one where it's not as tricky or as easy, so to speak, as where it's just bullish daily fair value gap, like the first example we had, where you're obviously drawing to something. But in this example, we would look at the market and watch that Asia high and low. And if we're bullish, like we're seeing price, whenever you see people talk about bullish order flow, because I used to always get confused. Like ICT would say, whenever the market is bullish, and it's like, why are you saying it's bullish, motherfucker? Like, what is bullish about it? Well, just the sell side's being taken, and we're displacing away from it, and then we're continuing creating this little trend, right, where a trend is created, it's ran out, and then we still continue, right? That is sell side liquidity being manipulated, or the lows being manipulated, and then we displace away from them. So in that context, and you're seeing this complex pullback kind of environment, I would just look for the next area where you're likely to reverse from. So you could look at this whole push up as an order block on a 4 hour. It's probably clearer, right? That caused a displacement down. So you'd be looking at it as, okay, the daily is likely to still go to the downside, right? But right now the market is still bullish. So what is it being? Why is it bullish? Why is the market bullish when we're in a premium? We've taken out a high. We're not really tapping into any kind of bullish price delivery, right? So why is the market doing this? Well, usually in that scenario, you can place your bets on that it's just pushing up to retrace, and then it's going to move down further. Who knows? It may just explode from here, but you don't want to navigate the market in that sense, because it's you just end up overshooting your targets. So if you're looking at the market as we have an area or key level where it's likely to go to, and we're currently bullish, you can watch for that Asia low to be ran out during that London session. Now, once that Asia low is ran out, right, again, we're just watching for a displacement shift in structure. And this is why sometimes it can be better to just market on the confirmation of the displacement, right? So in this example, we came up, we formed a high, right? Any candle that has a lower high on either side of it is a high. We're not going to wait for this to be taken, because that's just, I used to look at structure like that, and it's just a great way to waste a lot of time and be late on a lot of setups. But we take out these lows during the Asia session. In this example, we do not really have any kind of consolidation during the CBDR, so I wouldn't pay attention to it for standard deviations. But we take out that low, and then we displace the upside. So where is the displacement confirmed? Is it this wick? This wick? No, it's right there, right? You can then look to trade based off of this into this high if you have good risk to reward, but you don't. Now, if you don't have good risk to reward, again, there are two ways you can try to mitigate this. You can either just not take the trade. You can either look, where was the overall target at anyways, right? And if that meets 2 risk to reward, which it actually is right on it at this point, you can target it from that point, or you can try to wait for some retracement, right? Again, you can make stops tighter, right? But if you would have made stops tighter to get this 2 risk to reward, you need to also target tighter. So for example, like let's say if you marketed right here and you said, okay, well, my stop's going to go at the bottom of that candle. Well, you need to make sure you're actually targeting, because what people like to do is they like to move that stop up and then they move the target farther. And that's counterintuitive. But again, if you want to just use that Asia high as an easy target, that would be your low-hanging fruit. And again, why are we even bullish at this point? Obviously we see that we ran out lows. But remember, we think we're drawing up into some kind of higher level. Who knows? The market might just catapult from here. We don't know, right? But you can't operate like that. You have to look at it from a sense of, not overstaying your welcome and extracting the information you need and the move you need to actually make a little bit of money. You don't have to try to catch the entire move of the day. The thing that separated me from actually doing well and then, just analyzing things well was being able to take profits aggressively. And there's a fine line between doing that the right way and doing it the wrong way. I know you can definitely take profits too early, but that's why I really like mechanical risk systems, or I'm sorry, targeting systems. So, another way you could have done this let's say if you did wait for a retracement of this fair value gap, I mean, this example, you would have gotten a pretty good entry right there, and you could have just targeted out either this high, because that's way more than 2 risk to reward. You just target out 2 risk to reward, which would have happened very quickly. Or actually, I'm sorry, this low would have been the stop loss on that, unless you got stopped out. Sorry, I didn't move that. I was like, how's that 3 to 1? But so you could just target flat 2R. That's just the minimum for this setup or the other setup we're going to go over. You know, target out just recent structure, because then you're just playing this displacement range. Or you could target out that 1 hour order block or 4 hour order block. So you can see there's a lot of different ways to do it. I think the easiest way is the 2 to 1, right? Because again, these setups are very, very probable. If this occurs where you're looking at the market and you say, okay, I'm bullish, and we get a run on the lows and a displacement up, odds are, if you know what you're doing with bias, this is a very high win rate trade. Now, it's not going to be high risk to reward all the time, as you can see, but it's a very high win rate trade. So you don't need to have high risk to reward on high win rate trades. I'm actually curious. Let's see what the market did, because it might have just kept going. Who knows? No, it didn't. Maybe it did. Yeah, it did. For like a 1 hour. So it did keep going to the upside. So now in this example, and that's why I like picking out these, like, could you have just said, you know, people are going to go back and say, oh, dude, fuck, you should have just targeted this high, right? Okay, sure, whatever, right? If you did, great. You made a shitload of money. But this strategy isn't about always trying to min-max everything. It's about having something mechanical that it's really thoughtless, it's not stressful, and it leaves a lot less room for you to fuck it up. Meaning, like, yeah, we marked this out, but like, how many people are going to close when this happens right here? Oh, fuck, it's coming back down. Oh, shit, I'm out. And then it moves away from them, and they didn't get their good risk reward. You know, again, I think it's better just to take profits mechanically for this strategy, because really all you're doing is you're just watching a lower time frame segment of price. You're just watching an Asia low to get ran out and then a displacement. It's not like, you know, you're not layering in like a 4 hour order block to a 15 to a 5 minute and playing the pro trend whole impulse, expansion. You know what I mean? You're not doing all that. It's a very simple strategy. That's enough for the London session strategy. We'll go back to the New York one. So we'll go to GU and talk about this one first. So this was the trade we took earlier this week. Now the first thing was we tapped into this 4 hour order block, right? This hold down move is an order block. Tapped into that order block right there. Also, another thing, this is just a plus. This doesn't really have to happen with this strategy. Let me pull up the notes from the New York strategy. This was Wednesday. So again, if you guys have not watched I don't know why I said again, but if you guys haven't watched the weekly power of 3 or I think it's called weekly candle formation video in this playlist, go watch that. And if you guys hear me talk about on the streams all the time, the weekly profile, we're likely to put in the low of the week on a Wednesday. Now, if you can notice, we actually made a lower low on Friday, but at this time, that was another thing I was looking at, right? So you're always looking for reversal conditions on Tuesday and Wednesday if other analysis lines up with it. So how did other analysis line up with it? Well, we took out this liquidity into a 4 hour order block. Also, let's take a look at the dollar. So at this time, the dollar had traded into this draw it so it's clear. This 4 hour order block. Right? So Wednesday right here, 7. This was a Tuesday. And I was looking at this over here. So we ran out that high, and here we had traded into or traded above these highs. So anywhere above that, I was hoping the dollar was going to reverse. I was kind of honestly, I thought we were going to get stopped on that GU trade after I took it, but it ended up playing out nicely. But basically, again, we're just looking at the dollar, we're looking at a pound and seeing, are they agreeing? Okay, well, if the dollar is at, you know, smart money resistance, the pound is at smart money support. Okay, right? That to me, I'm like, okay, we're bullish overall on pound. Also, there was a daily impulse that was bullish when we were trading inside a daily fair value gap. A lot of reasons to be bullish, right? So This strategy goes as such, and it's actually, I think it's more simple than the last strategy. So again, the first thing you want to do is the higher time frame bias, but next you want to look at how did the London session trade, right? So I'm going to put times on this. We'll put a time at 8 a.m. Right, because that's after 8 a.m. is when you're going to be looking for an entry here. Now you don't have to enter it right at 8 a.m. This is one you really don't have to get some kind of sniper entry on. A lot of times it's pretty straightforward. And it's going to be on a 15-minute chart, the entry, right? So again, people are like, what? A 15-minute entry? How do you get good risk to reward? Da, da, da. But, again, you can try to go do this in a 1 minute, and I'm not saying it won't work, but again, the strategy, it just, in my opinion, it's a lot easier to catch more moves, like on different charts, using a 15-minute with this strategy. So after you've went over the higher time frame bias, you've went over DXY, which is something, again, you always should be doing that if you're trading Forex. You're going to want to look at how the London session traded. So you don't have to dissect it like how we were doing with the Asia session and the other strategy. You're just going to be looking for, what happened where was the displacement, right? What displacement happened during that London session, or since the London session, I should say, not during it, since it. So again, where is the displacement at? Well, if we look on this, I need to add these on because I get a lot of questions when I'm drawing OTE. So we look, the displacement, right, is right here. This is the displacement. Even if we had made another higher high, like let's say if we'd made a little bit of a higher high, but it wasn't displaced, I wouldn't even mark that. I would just mark the displacement, right? Because that's the bit of price we're going to focus on. After we do that, we're just looking to enter at OTE. Now, you can try to be sniper and just enter on the 705. Like, I mean, literally, you don't even have to look for a perfect area. In this area, we had a breaker plus fair value gap. Breaker, fair value gap right here, and an order block, right? So we had a lot of different things telling us that the market would likely to find support here. We had an OTE, we had a breaker, and a fair value gap. But again, you can just trade off OTE, which is the 6.2 to the 7.05 or to the 7.9. The sniper entry is considered the 7.05. Kind of wish I'd have taken it, right? I didn't even trade off that because the way that this model works, sometimes you'll see a 6.2 get hit, and then we just move from there. I wasn't at my desk when this happened. So when the market came up here, I looked at it and said, okay, I'm just going to take this trade from here because I still have good enough risk to reward, right? We didn't end up hitting our full TP. We got scam wicked there, but we did hit pretty nicely over here, that second TP. Now, again, I kind of wish I would have just taken 2-to-1 risk to reward here, just all the way flat. If you look, I'd have just taken that. Would have been just simple, a little bit more mechanical. And I'd have also been able to get that 2-to-1 easier if I would have gotten a better entry. Because really the entry should have been right here in this order block. Or if you're one of the people that just trades a 705, you would have got even better entry. See that would have gotten you a lot better risk to reward. So all you're doing, in essence, is after you establish, am I looking for buys or sells, right? Then you look at the London session, and since then, have we expanded? Did we get a displacement? Because those time-based dealing ranges are very valuable in terms of, kind of plotting out what direction this session is likely to do. So if you have that, you just draw a fib on that and look to enter around OTE. Again, you could target 2R fixed, or you can look to target this strategy, because we'll get a little bit more expansion sometimes from this since we're using a higher time frame. You can target farther. If you're trading pro trend like this, sometimes like what I did is just target out the high of the range. Almost hit it, right? But we didn't. And again, the 2R is fire, man. I'm telling you, like 2R is there's nothing wrong with just consistently knocking out 2R. I mean, let's just think if you're able to hit 2R, like let's say if you have 4 trades a week and you can win 3 of those trades with this strategy. Because this strategy, it's not like you're sitting there dissecting the 1-minute time frame all day, trying to get every setup there is. It's usually going to be like 1 setup, 2 setups a day max, right? And you can watch different charts playing this. But it's a higher win rate strategy if you do it correctly. So let's say if you could win 3 out of 4 trades a week, right? You can literally pass a funded challenge in less than 2 weeks doing that. Or I'm sorry, a phase of a funded challenge in less than 2 weeks doing that. But people will sit there and trade super low time frames and take 60 to 70 trades in a month's time to do the same thing. So for Forex, I firmly stand by 5 minute and up. That's just me having back tested a good bit, analyzing the setups I like using. Now for indices, I still like using the 1 minute. I'm even starting to use the 5 minute a little more for NAS because a lot of times if you're trading micros, you can get good risk to reward trading the 5 minute. ES, not so much usually. So it's a little different, but again, we're talking about Forex here. So it's really just as simple as that. You're looking for an OTE retracement during the New York session. Usually it's going to happen between 8 to 9:30. Sometimes it happens. I'll say it can happen even before that. Like a lot of times it'll happen like 7:30, 7:15. So you could even watch for it after 7, like the entry model to happen. But again, you just need that clear displacement, a clear bias. You need DXY agreement, and that's it. It's very simple. What's up? No, you could use this on Monday as well. I wouldn't use it on a Friday as much usually, just because on Forex, usually Fridays. I mean, last Friday we had a pretty big expansion. Usually during the New York session on Fridays, you're gonna have more of kind of like lackluster price action, like if you see here. But you can use this on a Monday again. And the reason that I like doing that mainly for indices is because I'm trading super low time frames. So you need like super precise conditions. But if you're not trading a 1 minute time frame and you're trading 5 to 15 minutes, usually on a Monday, if there isn't a setup, like, so it's easy, no matter if there is displacement in the day, no matter if there is like a big move, so to speak, there are opportunities that one could see on a 1 minute, right? But if there's not a big displacement on a 15 minute, okay, so if we're looking at Monday as a range day, we're not going to get this setup. Does that make sense? Because it's not going to give you that big push, right? Hopefully that answered your question. Of course, man. So with Euro, this happens, and we're just going to kind of skim through these because we're kind of running low on time, but you get the idea of it. But I'm just going to go through and just show you how well this works. I'm going to change my settings for OTE. There we go. So let's say we come into the market after that 8 a.m. or 7 a.m. area. Where's our displacement? Pretty obvious, right? So in this example, it literally went right to the 6.2 and then pushed away from it. So let's just say this is like, let's say you're not even looking at a bias thing. You're just looking at where did the market displace. Now, I'm not saying this is how you should trade this. I don't even know if it looks like it hit it, but let's say if you did this and just targeted fixed 2R. Your stop would be above here, right? Fixed 2R would be like instant, right? Now, yes, did the market go much further, right? Yes, for sure, right? It's not something you are always going to get the most of the move. Here's another setup right here. So where's the displacement? Right here. Because we didn't really have a displacement before that. If you look, this isn't a displacement. Now, it might have even got an OTE. If you look, I didn't even make it up to OT if you draw that. But again, we wait for a displacement to happen, and you watch target 6.2 of that. Again, or you could try to trade the 7.05, but I notice a lot of the times it just goes to the 6.2. That was why I entered that pound trade the other day. So now here's an example of where there's not even a displacement. It still works fairly well. I mean, you could maybe mark this as a displacement, but you would have got stopped out. I still wouldn't really look at this as displacement. You're not really taking out any structure. You're just really kind of pushing along. Let's just say if you mark just the London to, the London expansion, so to speak, or the London little range it formed. Market still comes down to an OTE. Right here, you would have got tagged in right there. Stop loss on the low. And you would have still been able to get a trade. Now, I'm not saying you should to do this, but, the market, it's pretty crazy how well this shit works, man. Let's go back over here. Looks like there's a loss because you wouldn't have hit a target here. It looks like it would have just consolidated. Because the trade would have gone something like this. So you'd have had a push down. If you just entered on OTE right there, and you targeted 2R, Looks like this would have been a stop out, right? Normal, it's gonna happen. Part of the game. So what is this? So this is supposed to be drawn right here. I think this is one of the ones that where it missed. So let's say if or no, right here, that's not one. There's another thing that I want to go over. So let's just say if you just target 6-2 right there, 2-1. It's pretty crazy. I mean, again, you don't have to. I mean, you're gonna see that it's gonna go a lot farther, but you know, consistency and the thing with me is I'm not like the reason that I haven't traded Forex as much is because of time. And I've noticed like I'm like, damn, like you're just I mean, I'm trading my Forex funded account, but it's not doing as much for me as it could because I've told myself like, oh, like, you know, you focus on just indices because I'm trading the 1 minute and the 5 minute a lot there and kind of dissecting the day. You don't necessarily have to do that to make good money. And I know that. I don't know why it's like I've kind of like brainwashed myself, so to speak, but anyways, this is why I like that setup. It's very easy, very mechanical. So, I mean, it's pretty straightforward, man. You know, I mean, we can keep going over them if we'd like. Let's see.
Yeah, is this strategy just short note?
So, no, it's just Euro is just bearish. This example, it can be for longs. Like here, let's find a long example. Let's say you would have gotten shit on here because this is I would have looked at this as like kind of the well, that's 615. Never mind. Where's 4? I'm sorry. Never mind. We wouldn't have actually. It actually would have worked. My bad. I always thought this was the beginning. So you'd look at this. This is your bigger overall displacement. You come back down to OTE. Is that 6.2? And this is like brutally simple. And again, I'm not saying this is because there's going to be people that are like precision technicians that are going to not like this. I get it. I understand. Again, this is a very simple model. It's not meant to be like ooh and ah, but it works pretty well. So we'll go over here. So this one right here, I mean, you probably got left behind. That's this one you would have gotten left behind. That's going to happen sometimes as well because I would have been like, oh, okay, here's your limit. I push the upside. It's fine. There's not. This is a okay. Here's a good example too. This wouldn't give you a setup. Like there's no displacement here, right? There's just not. This is a day you don't trade. I think this was maybe where CPI and shit was around this area, but this is a day you just chill out. As for another thing about like CPI and red folder, just if I wouldn't, it's just like any other strategy. Expect 0 if you put yourself in those kind of predicaments. I'm not saying that it's not going to work because it does a lot, but it's just not something you want to, you know, not a great habit to get into trading that kind of stuff, you know. Yeah, that's pretty much it, man. But again, just for both strategy, the London strategy is just waiting for Asian liquidity to get ran out. 5-minute shift in structure with displacement, fixed 2R. There's that kind of like trade within a trade that we talked about at the first example where you can kind of trade counter bias, just lower probability, maybe something you use half risk. New York model is, I mean, I don't know how much simpler it could get. And again, this is stuff for Forex. And notice, this is what the problem sometimes whenever I teach these kind of models. Everything that we've talked about for the last hour is going to go out the window, and everybody's going to just see that and then wonder why it doesn't work for them. So just be mindful of that it's easy to do that. It's very easy to just be like, you know, fuck everything else he just said. Fuck the DXY agreement. Now, again, I've showed you guys that it does work pretty well just using this. But if you want to, if this is hindsight, if you want to be confident and have, you know, consistent execution, it's important that you're looking at other factors. So if there's any questions, go ahead and run them. You know, I appreciate you, JC. Much love. Yeah, if you guys have what this one right here. So this is 6:15 at 8 a.m. I just keep my overall bias on. Like, so in like the pound one, I just looked at like this was really all I needed was just like this. That was because like again, now if I'm just trading this chart, would I just sell off that? No, right? But if I look at this and then I look at another chart that so like I always like to try to take concepts or like thoughts and get logic from them. So let's just this is a really good example to explain something like a mental pathway I have. So let's say if this is our level. What is this level? Anything, any fair value, whatever. What do we look for in terms of entry? You look for this. It's that simple, right? But what is that doing, right? What is that market structure shift doing? It's just confirming your idea. It's just like when retail traders have like 5 or 6 indicators telling them the same thing. It's a confluence, right? Obviously, we look at this as a better strategy. It's why we trade it, but it's the same idea behind it. It's just you have multiple things pointing to the same thing. So if my thing with DXY is I need 2 things as a confluence, right? Maybe instead of looking for this, I'm looking at the pound, seeing if it looks, maybe that's my market structure shift, so to speak, right? We talked about the advanced market structure stuff where maybe, you have this low form in it, you run it, and then you form this other low right here. Maybe that's your confirmation, right? Maybe you have SMT divergence with the pound. You see what I'm saying? Like there's a lot of different things that can be confluences. So you just look at these as tools in your belt to kind of confirm what the overall narrative is, if that makes sense. But okay, let's go back. I'm sorry, I just completely went on a rant and just didn't. What was the 6:15 was the date? Hold on, 6:15. So okay, again, it's very similar actually. Look, displacement down right here, push down. Where did we go to? Order block right there. The 6:15 was right here on this day. So if we're looking at that 4-hour order block, you mean like a 15-minute. Sorry, Alex, I had to mute you. We traded into it right here, took out liquidity, and then shifted down. Came and took that liquidity again. But see, at this point, I would be bearish on the dollar, even though it did end up pipping the high again. And again, you displaced down, but bearish on the dollar. So 6:15 remember that was like 8 a.m. on the dollar. We'll go back and check. But I mean, like, look at this. Like, I mean, if that's not a fucking short, I don't know what is. There's not 2 fair value gaps. Or wait, actually there is. Yeah, there is. You're right. But it didn't hit the there wasn't a tap. Let's actually see. Hold on. Is there a tap? No, that first one didn't tap into it. It does look like it though. Because it would have been like something like this. But we need that tap and then a tap into it. But yeah, no, I can see what you're saying though for sure. Yeah, man, it's like if you look at this and you're like, okay, I mean, if that's not a fucking short, and that's the thing that's cool about the dollar too, man. Like, I wish sometimes I traded the dollar because its PA is fucking clean. Like, as far as like shit like this on like a 15-minute and a 1 hour, like the 1 minute gets a little choppy, but like 5-minute and 15-minute on the dollar is clean, bro. And that's another nice thing about Forex is like, because when you trade indices, like I see so many people trying to use DXY with indices, and it's something you should pay attention to, but it is not anywhere near as indices are not going to react the same as like Forex does. Because there's times where you'll see indices fly and the market fly, right? Because it's just basic economics. But that's why it's not as powerful to use them together. So hi asked, what do I think about DXY? So DXY, man, is that weekly displacement strategy would tell us to look for this high up here. What I want to see in order to kind of resume that is I want to really see how we open this week, because this to me isn't really enough yet. Yeah, we closed above it, but that's not displacement. I can see it forming though. I definitely can, see the idea for a bullish scenario. I want to see us displace to the upside, and if we can hold that displacement, I'll look for a bullish dollar for sure. Another thing too on euro that I've been paying attention to. If we look at this on euro, I'm just gonna delete everything. What else do we have on euro? Right, we have that same strategy, but they're both in those areas where we're like kind of Not sure on them, but again, trying to be mechanical, this would lead to a bearish euro, right? But what we would want to see here, ideally, is exactly what we're seeing on the daily, right? So notice how we have that weekly fair value gap, right here. So what do we want to see inside that on a lower time frame? Tap and a sweep and a shift, right? Now we haven't really got that. I won't call this a shift yet, again, but if we start to shift here on the euro, I think it's going to be bear city for these lows and this low. You know, that's what I'm seeing on the euro. It's not necessarily there yet, but that's I was looking at this actually last night when I was just chilling. I was like, oof, euro, because like I kept trying to like almost psych myself out. And again, we'll see how it opens up. Now if we're not getting confirmation of this, I won't look for it. But you know, this is what I'm seeing at the or as far as the euro goes. Um, how do I think of? Oh wait, do I still use 4 hour to confirm the weekly POI? Usually I like watching a daily. I'll do the 4 hour like if it's a little bit more aggressive. Like if I'm, I guess in this example I probably should be using the 4 hour to be quite honest, because I would be looking at this as a higher probability circumstance. But you can use the 4 hour kind of as a more aggressive confirmation of the weekly. I guess my brain's just making me want to really see confirmation, because you're actually right. Hi. So I mean, I would probably lean more towards this scenario playing out. Yeah, on that note, guys, I'm gonna hop off here. The video will be uploaded to the playlist. Probably give it like an hour or so. And if you guys have any questions, as always, feel free to DM me, at me in chat. Let's have another good week. Let's actually take a look together at the calendar for this week. Oh wow, not shit really. What do I have filtered? Oh, why do I have these filtered? I swear I don't even remember picking those. Let's see what we have for everything first. Yeah, it's a flat ass week as far as news goes for most. We have GDP month over month, and then we have GDP actually. Never mind. I'm tripping. It's not gonna be a flat week. Yeah, so USD CAD might be something to watch this week. Anyways, on that note, guys, I'm gonna hop off here. As always, I appreciate you, and I will see you guys on. I'm not sure which day. I need to put up the schedule. I have to kind of map my week out. Probably Tuesday, Wednesday, or Tuesday and Thursday, or something along those lines. But yeah, I'll see you guys later. Peace.